And now turning to Asia, the performance of the region this year has been the worst since 2013. But of course, that could throw up quite a few opportunities. Let's find out from Geoff Bazzan. Maple Brown here in the studio. Yes, EM versus DM. It hasn't been a great comparison here, has it?
No, it's been a shocker. But if there is a silver lining, as you alluded to, it's the worst year we've had since 2013. And historically, when you have a period of underperformance such as we've seen, you normally see a decent recovery. You have to go back to 2000, 2001 actually to see consecutive years of negative returns in US dollars for Asia. And broadly speaking, we are seeing plenty of opportunities to keep us optimistic as we look into next year.
So would the EM underperformance be linked to China and vaccinations? Would they be the top two risks that they experience this year?
Well, China's certainly the biggest market in the EM complex, so that's brought the whole thing down. But you've also had some other factors affecting some of the non-Asian EM countries, such as Turkey and Brazil, which have had some pretty serious issues on an economic front, and also from COVID for the case of Brazil. But certainly China has probably overshadowed events in EM this year, given its size and some of the magnitude of the issues that have gone on there.
And of course, frightening people with regulatory changes has been a big setback for investor confidence in China, you think?
It has. I mean, I think some of it's probably been overplayed in terms of how it's been extrapolated to other sectors or parts of the market. If you look at some of the policies, frankly, it's hard to criticise some of them in terms of what they're trying to achieve in terms of better efficiency, better allocation of resources, and seeking to curb some of the overreach that some of these companies had. And indeed, I think there are issues that some of the Western governments are considering as well.
Yeah, absolutely. If we had data privacy and access to education, we'd be applauding rather than being nervous. So overall, you were saying your portfolio is up 9% in Aussie dollar terms. That's because the portfolio as a whole is unhedged?
That's right. This year we've remained unhedged. Obviously the Aussie's been quite weak against the greenback, and typically that's been the case for most Asian currencies that have sort of lagged the US dollar. So it's been a slight tailwind in an otherwise pretty tough year, given the markets are generally down in US dollars, as I mentioned.
And of course, China isn't just Asia. Like, two countries that spring to mind that have really laboured this year have been Indonesia and Thailand, really impacted by low vaccination rates. Thailand, for example, I used to go there a lot when I lived in Singapore.
Yes.
Half the country is shut down without tourists. Does that mean there's a strong opportunity for upside next year?
Yeah, you would think so. The pace and speed at which they recover and open up is obviously a question to be answered. But if you look at pre-pandemic tourism levels in Thailand, they were running at something like 40 million visitors per year, and about a third of those were from China. And if you go back a decade or so beyond that, there was very little visitors from China. So you've seen exponential growth over the last decade or so. And it's reasonable to assume, I think, once we get in control of this thing, assuming we do, or more used to travelling and managing it, that you'll see a big pickup in that part of the Thai economy, which is frankly crucial to the country as a whole. So yeah, I do think that's a potential upside looking into next year. And Indonesia, as you mentioned, has also seen actually a dramatic decline now in hospitalisations following the vaccination program they've had, and we've seen a sharp pickup just in recent weeks actually in things like consumer confidence, etc., which hopefully give optimism that again we'll see that economy starting to re-emerge from its hiatus.
So when you're looking to structure your portfolio next year, would you suggest, say, the US is overstretched, so you're looking for opportunities elsewhere? We all know that rates are rising and inflation is either here to stay or maybe not here to stay. What's your view on that?
Yeah, I read somewhere recently that comment from Warren Buffett. I think he said that interest rates are to equity valuations that gravity is to matter. And it's a simple comment, an obvious point, but one that's probably often forgotten, a period that we've had the last couple of years with so much loose, effectively free money. So yeah, our assumption would be, as we start to see rates normalise or even go up modestly, that it will continue to bring about a pretty sharp rotation in the market from those parts of the economy or the equity market that have really sort of relied on free money and sort of speculative excess, for want of a better expression, towards fundamentals and some regard for valuations and cash flow, dare I say.
So in terms of like a themes heading into next year, would you be looking favourably at tech or the consumer, or any sectors you would love or avoid? Yeah,
so we're bottom-up stock pickers, so we tend to focus on the individual company attributes, and we have a strong discipline towards valuation. So they're the key drivers that are sort of impacting what we're looking at. But at the same time, obviously we've seen some big moves in some of those sectors you mentioned, technology being one. So there are opportunities in the tech sector, but more in aggregate, I'd say our portfolio is comprised more of the typical sort of cyclical stocks, including financials that have really struggled over the last few years, and where we continue to see very strong and attractive valuation support.